Good morning here, Facebook Live. It is Brian Sinkoff, Associate Real Estate Broker, Muccio Real Estate Group, and Drew Aiello of Fairway Independent Mortgage. Here we are at the Muccio Real Estate office, specifically my office. Drew, what do you think of the digs?
Digs are good. I could tell you're a sports fanatic.
Yeah, we got a lot of sports fanatic stuff, a lot of stuff at cons, meeting people at Comic-Cons and sports heroes and all that type of stuff. So here we are, settled into the office. We want to say Happy New Year.
You know what? Today is the first working Monday of the year.
We actually talked about this on the phone this morning.
True.
Doing some prep. This is the first full work week in a month.
Right. We had Thanksgiving. We had Hanukkah.
We had the week before Christmas, the week of Christmas, the week after New Year. So crazy stuff. Yeah. All right. Yeah. So, and I point out the new year. This is a little cockeyed. That's what she said.
It's perfect.
No, it's a little crooked. All right.
We are.
Okay. We got good audio. Daryl said we're good with the audio. All right. Thanks, Daryl.
My brother Daryl's other brother Daryl's other brother Daryl.
Nobody knows what that means if you're under 35. So, wanted to talk about the new year a little bit. And the reason we said Happy New Year and talked about the new year is because with the new year means new visions, new hopes, new dreams, new goals. I can't tell you how many times, I don't want to say on January 1st or January 2nd, but I can't tell you how often the phone rings with the new year because, Drew, people make their New Year's resolutions. People say now is the time. People are sort of ready to buy.
The holidays and all the minutiae of the shopping. And
you feel that too?
Yep. I felt like last week, even though it was a shortened week, that the floodgates kind of opened again.
Yes.
Where it was really quiet during Christmas, New Year's. And then last week, even though Monday was technically a holiday, slammed on Monday, Tuesday, Wednesday, Friday. I even went in on Saturday morning at 6 a.m. to try to catch up.
This guy's working.
It was all of a sudden it was like a light switch that went off in the world. And it's funny because you and I, we talk a lot, obviously, about deals and real estate, of course, because that's what we do. And for 2.5 years, there were certain deals we couldn't do, right? Because of the market and how competitive it was. And now a whole different segment of buyers is coming back into the market. And
we're going to get into that in a second. Drew, we have talked about the rates, and I know specifically you can't talk about like the rates and the APR and things of that nature, but the rates are definitely coming down. We can say that much.
It's night and day compared to last year. So when we talk about the new year, I think you're going to see a market difference between 2022 and 2023. And that last year, the entire year, we were like this for rates, right? Mm-hmm. This year, as of November 10th, it's going to be like this. It's going to be choppy, not going to go like this in a straight line, but the overall trend for 2023 will be a much different interest rate environment. I think you're going to see rates down near 5% the middle part of this year, and by the end of this year, you might even see rates back into the 4s.
Which is phenomenal. And, we were like that a year ago, and it was, they were under 3%. I don't think we'll ever, I'm making a prediction that I don't know that we'll ever see that again. That was kind of crazy and sort of pipe dreamish. But you touched on it, Drew, and you talked about sort of buyers because the rates went up a little bit. The market, I want to say, cooled. I don't even think cooled. I think went back to normal, marginalized, went back to normal rates. I think the playing field has leveled out a little bit in terms of buyers now having a chance, in terms of every type of buyer. I have clients, and they came to me a year ago. I'm not going to mention their name. They came to me a year ago, and that's the one thing about Drew and I. You'll find if we don't think you're in a position to buy in terms of your situation, your financial situation, or even your rental situation, we're not afraid to tell you, wait. Or, if you're not going to qualify for something you want, we're not going to be afraid to tell you that. But these were particular buyers. I'd say about a year ago, they came to me. They needed an FHA loan and they needed seller's concessions.
I think it was 2 years, to be honest with you.
It was definitely over. It was a while ago. And I literally told them, I said,
I've been working with them for a couple of years now.
And I literally said to them, wait it out. And they're like, really? I said, absolutely. you're going to have no chance to buy a house in a market where the rates are under 3%. We're getting 5 offers on every house, and they're not going to entertain contingencies, and they're certainly not going to entertain seller concessions.
Right.
And an FHA loan. And we're going to get into that in just a second because I want to explain, because a lot of people, this may be too inside baseball. Right. But we'll actually, before we explain what seller's concessions are and an FHA loan and why it's maybe not as popular as a conventional.
So what was happening the last 2.5 years since COVID basically is the market exploded, a lot of pent up demand, and like you mentioned, 5, 10, 15 offers on a house, offers
literally
over asking price by tens of thousands of dollars. And so if you're a seller and you're looking at 20 offers, if one of your offers is an FHA mortgage and one is a conventional, which is the generic version of a mortgage, the seller, who can be very picky in those situations, will say, I don't want the FHA buyer, just because they have a stigma of the appraisals being a little more stringent than a conventional one. So if you're a seller, you're going to pick the path of least resistance. That's human nature, right?
And traditionally an FHA will have less money down than a conventional. Right. You talked about inspection issues, chipping, paint, lack of handrails. Certain things with the deck, wells, septic, those types of things. It's just basically, to not get too inside baseball, it's just adding extra contingencies, adding extra stuff
pickier
into a loan. And when there's 5, 10 offers, literally, why go with the offer that has those contingencies? You want sort of a cleaner offer. So go ahead in terms of, and then seller's concessions.
So if I came to the table with an FHA mortgage financing program and you came with a conventional program, the seller's going to pick you, just because my appraisal is going to be a lot more stringent. So that segment of the market has left us for the last 2.5 years. And now with rates going up, there's a lot of people sitting on the sidelines and waiting for the rates to come back down, so that the buyer that has an FHA loan is now back in the market because there's less competition. I would say the market isn't going down when it comes to appreciation. It's kind of leveled out and gotten a little soft, which obviously that's your department.
It's normal.
That's what I see.
It's normalized.
Right.
And
normalized.
Which is good.
It's good for those buyers because they might be short on funds. So a seller concession, to answer your question, is, let's say a house is selling for $100,000. You can make the purchase price $106,000, meaning you can go up to 6% of the purchase price as a seller concession. So it's a creative way and legal way to roll in your closing costs into the mortgage. The seller's still going to get their $100,000. You're just bumping the purchase price to $106,000, and that $6,000 difference will come back to you at closing.
Right, back to you at closing in terms of
costs.
In terms of you, slide over a little. In terms of you, inside baseball, we're discussing our positions in the camera shot. Anyway, in terms of you having to bring that money to the table, it's just alleviating that, alleviating the amount of money you have to bring to the closing table.
Right, because a lot of people, I think, can afford a mortgage payment on a monthly basis. That's the beauty of living in upstate New York. Affordability is great, unlike obviously downstate New York City and other parts of the country. So people are paying $1,500, $1,800, $2,200 a month in rent, can have a house for that payment. But it's not just the payment, it's also cash to close.
Right.
So seller concession, rolling in closing costs, is a very creative way to help with the liquidity piece of buying a house.
Now, I can safely say, and we actually talked about this literally the other day, I can safely say I have not had one house, whether I've been the listing agent or on the buy side, since June of 20,
right,
until very recently, there hasn't been one house or one deal that I've done that is involved an FHA loan with seller's concessions. I can safely say that, hand to God. I have not seen it. Well,
right.
Guess what?
We saw it last week.
We saw it last week with my client. Well, actually, it was a week of New Year's. Right. Saw it the week of New Year's with my clients who were on the fence, and I told them wait, and then I said, you now have a chance because the rates got a little higher. Other buyers are sort of waiting for Godot, waiting for the rates to lower, and because of that, the market is a little softer, so sellers are more willing to work with people just because they're real buyers. You know, they're buyers out there, and they're more willing to work with it. Hey, my house can be sold. Okay, there might be a contingency or two I have to get through, but at the end of the day, it's a real buyer, and my house is going to be sold. So those clients of mine who needed seller's concessions with an FHA loan got a house in this market.
Right, and this was a good one in the sense, I think there was $12,000 or $14,000.
Oh, it was
rolled into the mortgage. I haven't seen that in 2.5 years.
Oh, it was every bit of 12G.
It was 6% of.
It was every, and we're not disclosing names, so we're just using generic examples here.
It was great in the sense, the way we structured it was so that the buyer, your client, just had to come with their 3.5% down. All the closing costs, the taxes, the insurance, attorney's fees, everything else was rolled into the mortgage for them. So it made their down payment as small as possible, which is great. It's something we've done for 30 years. Now it just went away for a couple of years because the market was so competitive. So it's good to see, because unfortunately there's a lot of buyers out there that want to buy houses that don't have $20,000, $30,000, $40,000 to put down. So it was really nice to see. It's a feel-good moment to have that segment come back.
And that is the beauty of this, because I don't want everyone to think gloom and doom. I don't want everyone to think the market's soft. This is actually a very good market for buyers, and to be honest with you, for sellers, because everybody wants $50,000 over the asking price. But as I've said, and I've said this for 2 years, it was what? eBay on crack. It was eBay on crack. It wasn't realistic. I go back to the example, a house listed for $250. It sold for $330.
Yep.
$330,000. A house was $250.
That's
not normal.
And don't get me wrong. I talked to a gentleman on Saturday, and the list price I think was $445, and he made me do the pre-approval all the way up to $485. So you're still seeing that.
Still seeing it. You're still seeing it.
Competitive areas.
And price points. Yeah, right. You're still seeing it.
So no, the market. Don't believe everything you see on CNBC or some of the national news channels, because real estate is very specific to the area that you live in. And right here, we actually have a good balance of supply and demand. Don't you think supply is still a little bit tight? Well, very tight.
Yeah, you know, it's funny. I was actually thinking about this on the drive over this morning. Everyone's like, the supply. I don't remember when the supply ever equaled the demand. Did it ever equal the demand? I mean, maybe in 2008,
probably 2009.
But let's just think about this, because we're talking about, well, you know, there's this many houses and this many buyers, right? You learn this in economics class. By the way, side note, economics class at Maryland, University of Maryland, I still to this day have nightmares about missing that class. Like skipping the class and then you have a test. Do you still have that nightmare?
You're talking to an economics major.
I hated I hated economics in college.
Deep in economics.
I hated it. And Mom, if you're watching, I'm sorry, cover your ears. I skipped that class. If I had that class 3 days a week, I skipped it 2.5. I never went. And then, because I like to rub elbows with people in the class, got the notes from a young lady in class, and she helped me study. So I, somehow passed it. I think I got a C. I was like a good C student in college, solid. Anyway, I digress. All right, let's talk about supply and demand. Speaking of economics, we all know how supply and demand works, right? Big supply, not as much demand, the price has to come down.
Correct.
Demand, less supply, the price has to go up, right?
Correct.
But let's think about supply demand for a second, and let's think, all right, you have how many houses in the capital region? I don't know, but there's 1 million people that live here. Let's say there's
1,200 listings, do you think?
Yeah, but think about this. How many apartments are there, right?
Right.
How many people live in apartment complexes? Now, not everybody that lives in an apartment. See, I thought of this today. You're going to like this.
Good.
Not everybody that lives in an apartment. Yeah. Not everybody that lives in an apartment complex is going to want to buy, correct?
Correct.
But let's just say half of them do. Fair number?
Yeah.
50% have a goal, 1 point of buying within the next year. Do you think 50% of homeowners have a goal of selling?
No.
Probably not.
Probably not.
So let's just run those numbers. There's probably more people in an apartment than there are that own a home. Would you agree? Or it's pretty damn even.
I would say, yeah.
Pretty damn
They're
even.
Putting up apartment complexes like it's
pretty even. So let's think about those numbers. This is you're just getting serious in-depth crap right now.
But I did notice, because rates, a lot of the millennials, which is the largest population generation that we've ever had, bigger than the baby boomers, because rates went up, went back to living with mom and dad. And then when rates come down in the next 6 months, they're going to come back into the market. So that's why I like this period of time.
It calls.
Because I say this, you date the rate
and you marry the house.
If you can get the house now, get it now, because there's less competition. And in a year from now, you can always refinance.
Correct. So going back to my little, and I'm going to finish this scenario, amount of people in apartments, amount of people own homes, maybe 50% of people in apartments want to buy. I don't think 50% of sellers want to sell. We didn't talk about people living in mom's basement or in the bedroom. So now,
the bedroom.
Not mom's bedroom, mom's basement or the spare bedroom in the house. Not mom's bedroom. Woo, that's a whole other Facebook Live.
Yeah, not this one. This is PG.
This is G-rated. So, yeah, PG. So, just think about that. Is the supply-demand ever going to be even?
You know, in our
that's what I mean. Like, it's just it's just because there's more people that are renting apartments than own homes.
And you know, it's just really strange to say this. We've had record low numbers of foreclosures. And believe it or not, foreclosure activity, as sad as it is part of supply. When you have more foreclosures, more houses come to the market, and foreclosures is like 0.1, 0.2. It's the lowest it's ever been in the history of housing. So you don't even have that segment of the market coming in for supply. So supply, I think, is tight. I don't think it's going to change anytime soon. Nope. It's not like you can just flick a switch and all of a sudden you have houses. So I think bottom line, you have to have your ducks in a row, get pre-qualified, make a good offer, don't mess around, right? I mean, you got to put your chin strap on and be ready to go in and do battle, because there's still competition.
Correct, especially in those competitive price points in those popular school districts. Drew, you look at the market, you look at the Fed, you look at things like that, you look at inflation. What can you tell us this week?
I like to dispel one of the biggest myths that's out there right now. And that is, with the Fed increasing interest rates, that's what you think in your head, is the Fed is increasing interest rates, that means rates are going higher. Not true. The Fed increasing interest rates controls the short-term rates, controls the home equity rates, the prime rate, the Fed funds rate, does not control mortgage rates. Since the Fed been bumping, the last few months, especially 0.75%, 50 basis points a couple weeks ago, mortgage rates have actually started to decline. And why? Inflation. Inflation is what moves mortgage rates. Now we're starting to see inflation peak and start to come down, and lo and behold, mortgage rates are also coming down. So even if the Fed continues to bump rates, that does not mean mortgage rates are going up. Mortgage rates are actually starting to come down, even though the Fed is probably not done bumping interest rates. So don't let what you see on TV and the media scare you from buying a house because interest rates are actually on their way down, even though the Fed's not done yet. So inflation is what moves mortgage rates, not the Federal Reserve.
And in terms of bumping the rate, you're talking about credit cards, car loans, things of that.
Right, exactly. Not mortgage rates are market driven. The Fed cannot control mortgage rates. They can try, they can do some bond buying, things like that. But in general, mortgage rates are totally dependent on inflation. If you have low inflation, like it's not low yet, but it's starting to come down, then you're seeing mortgage rates come down. We went from probably low to mid sevens to now around 6%. I locked a guy on Friday under 6%. That's in the face of the Fed bumping rates, just to put pen to paper on my example. Totally what's happening right now in the market.
And you talk about that 7%, 6%, 5.5%. That's still about the average or a little below the average of the mortgage rate average for the last 20 years. I mean, people have to keep that in mind as well.
Want to blow your mind?
Yeah, go ahead.
The average rate over the last 40 years, 8.25.
Oh my gosh.
Right.
Well, my mom, she bought a house in '86. I think her rate was 17%.
Right. That was the peak. I remember there was a line around the building trying to get a 9.5% 1 year adjustable. It was unbelievable because they had 15-16%.
Right.
And then we went down to 9.5 on a 1 year arm.
That's half what they were paying.
Nuts.
Right. So
Yeah.
that's crazy.
I don't think you're ever going to see 2.5 or 3 anymore. Something unfortunately really bad would have to happen, like a COVID, right? That was probably one of the worst economic situations we can ever be in as a world. The whole world shut down.
Right.
So that's why when there's really bad stuff out there, rates go down.
Because it honestly, we've talked about it, real estate sort of saved our economy for about 2 years,
It's the
year and a
foundation
half.
of the economy.
I mean, it honestly did. So the rates went low for a reason.
Right.
All right, let's before we're going to wrap up here, and if you guys have any questions, feel free to text or send me an email. I did get one question, actually 2 questions earlier. This is Corey asked, Brian, what do you think the spring is going to be like? It's a good question. I can tell you with the example we gave with my clients getting the FHA loan with sellers concessions, I said to them, actually when I delivered my holiday mugs,
Right.
I paid them a visit and they asked how the market was, and I said, you got about 3 to 4 months. 3 to 4 months, because what's going to happen is, what's that?
A little window.
Yeah, what's going to, I don't know what that was, but you know.
Window.
Oh, okay.
G-rated.
Yeah, see, that's why you watch this, because you never know what's going to come out.
Because never know what's coming out of our mouth.
So, where the hell was I?
Talking about your clients.
Talking about my clients. I said the window is, no, all jokes aside, the window is going to be very, very low, very small to buy a house. And now is the time, if you're not an A-plus buyer, and there's nothing wrong with that. Look, my wife and I, when we first bought our house, we were not, we needed concessions. We got an FHA loan, nothing wrong with that. You're young, you don't have the equity, you don't have the money, things of that nature. I said your window is going to be very small because the rates are what they are, and buyers are sort of waiting for the spring, and when the rates tick down a little, you're gonna have it's gonna be like I don't want to say eBay on crack, but it's gonna be
Competitive.
It's gonna be very
It's not
competitive.
gonna be like it was, but it's definitely gonna be more competitive.
And you also have to remember this: in any market, right? In any market, I say this to every buyer and seller: when the final snowfall melts,
Right.
okay, and it's 60 degrees, you go outside and you're like, oh my God, I can sit on my porch again. I can walk my dog without freezing to death. Guess what? People want to buy a house, and that is like the time. But I tell everybody, well, we're going to wait till spring. Well, the problem is everyone's going to wait till spring.
Right.
So
I like buying my winter clothes in the summer. I like buying my summer clothes in the winter.
Yep.
When are you going to get a deal? When everybody else isn't doing it.
Yep, exactly. So you get your winter coat. I got a really nice coat right over there, that black peak coat. I got that in March of last year. I think it was like
Want to buy
$90. It was like $300 normally.
Buy an SUV in July when it's 90,
Yeah.
not November.
Right, exactly. So yeah, that was what will the spring be like? The spring's probably going to be busy because
heat up.
they're always busy, and if the rates tick down at all, it's people are calling. They want deals. They want deals. Drew, anything else you wanted to add?
I think we said it all. I think we talked about the market. We talked about where interest rates are going. I think 2023 will be a much better interest rate environment. I always get asked the question on new construction: should I lock for 12 months? We do have a 12-month rate lock, but unlike last year, you had a lock starting March. This year, if you went to a contract on new construction, rates are probably going to be going down for the next 12 months. So I don't think there's that much of an urgency to pull the lock trigger. Granted, I don't have a crystal ball, but that seems to be the way that we're going. I feel like the Fed is almost pushing us into a recession to try to get costs down, energy, food, shelter, all those costs down, so that inflation can go down. And they have to get inflation down. It seems like they're very fixated on getting inflation down. If that's what they're doing, That's what they're trying to do. It seems like it's working. Then you'll start to see mortgage rates go down. So I think 2023 will be a much different interest rate environment.
So there you have it, straight from Drew Aiello's mouth. Brian Sinkoff here. If you have any questions about real estate, if you just have a question about, hey, can I get pre-qualified for a loan? How does this work? What do I need to bring to the closing table? How much am I going to need out of my pocket? Give Drew Aiello a call. He's with Fairway Independent Mortgage. You can always reach out to me, 518-364-9497. Sell It with Sinkoff is my website. You know how to get in touch with me.
I like that.
You can Facebook message me. You can hit me with a hot mop. Whatever makes you happy, you can get in touch with me. So I want to thank you so much for watching. We're going to be back next month.
Once a month now.
Early February.
It's our third one.
Yes, we're going to be back early February with another update on the market. I look forward to hearing from you soon. Drew, anything else you want to say? Hi to your...
Happy New Year.
Yeah, Happy New Year.
I hope everybody has a safe and, more importantly, healthy and prosperous New Year.
Yes. You guys take care. Have a great day. And we will talk to you next month.